Welcome to the Explainer from Talk Tickers. So HP just dropped its latest earnings, and on the surface, things looked pretty good. In fact, it was their sixth straight quarter of revenue growth. But then, the stock immediately took a nosedive, tumbling 6%. What's the deal? In this Explainer, we're going to dig into exactly why a seemingly solid report sent investors running for the exits.
Yeah, this is the central question, isn't it? You've got this positive trend, but the market's reaction is, well, the complete opposite. It's a classic Wall Street puzzle. So let's unpack this apparent contradiction, and we'll start with the headline numbers that everyone sees first.
All right, first up, let's look at the earnings snapshot. And, when the numbers first came out, the initial impression was that things were looking pretty stable.
Okay, so as you can see right here, revenue came in pretty much exactly where Wall Street expected it to be. And then you look at the non-GAAP EPS. That's the earnings per share number investors really focus on. And it actually beat the consensus. So on paper, you're looking at this and thinking, hey, that's a win.
But, and there's always a but with these things, the devil's in the details. That earnings beat was by just 2 cents. Now, a beat is a beat for sure, but it's not exactly the kind of blowout number that gets investors really fired up.
So instead of really focusing to that tiny beat, management was quick to point to the bigger picture. And you can't blame them. They hammered home that this was HP's 6th consecutive quarter of revenue growth, and it was mostly fueled by their personal systems group, that's their PC business.
Okay, but this is where the story really starts to get complicated. Because when you peek under the hood, HP is basically two different companies right now, and they're moving in completely opposite directions.
And here's the core issue in one slide. On one side, you have the PC business, which is thriving, up a very healthy 8% from last year, really driven by that AI PC excitement and the Windows 11 upgrade cycle. At the exact same time, you've got the legacy printing business, and it's in a steady decline, down 4%. And if we dig just a little deeper, you can see the engine of growth is clearly the AI PC. I mean, it's now making up over 30% of their shipments. That is the future HP is betting on. On the flip side, the printing division is just getting hammered with double-digit drops in hardware sales. They have a little bright spot in their consumer subscription service. It's almost a billion-dollar business now, but it's just not enough to turn the whole ship around.
So you've got this really mixed performance, right? It was basically the setup for the most important part of the whole call, the forward guidance. And folks, this is what sent the stock tumbling down.
And boy, was the guidance a major disappointment. As you can see, Wall Street analysts were looking for earnings around $3.40 for next year. HP came out and guided to a midpoint of about $3.05. That's a huge miss, roughly 10% below expectations. For investors, a gap that big is a massive red flag.
So, why the big miss? Well, management pointed to what's basically a perfect storm of headwinds. The number one culprit is a sudden, sharp spike in memory costs. That's a key component in PCs. It's a cyclical thing, but right now it's hitting PC makers hard. You combine that with some extra expenses from trade regulations and that ongoing weakness in printing, and your profit outlook gets pretty challenging fast.
In response, CEO Enrique Lores basically said they're not just going to sit there and take it. They're taking what he called a prudent approach to their forecast, but they're also launching a new aggressive restructuring plan, using AI to help them cut costs and streamline how they operate.
Now, restructuring is almost always corporate speak for a painful reality, job cuts. This new plan is designed to save $1 billion a year, but it's going to come at the cost of 4,000 to 6,000 employees losing their jobs over the next few years.
So, what we have here is a classic conflict, a decent quarter in the rearview mirror versus a really challenging road ahead. So, how did the market weigh these two opposing forces? Well, the reaction was pretty much immediate.
The market's verdict was swift and it was decisive. After the stock closed the regular day at about 24:30, the call started, that weak guidance came out, and boom. In after-hours trading, the price plunged down to around 23.10, a drop of about 6%. This is a perfect example of a fundamental truth on Wall Street. The market is always looking forward, not backward. The solid results from Q4, the 6 straight quarters of growth, all of that became totally irrelevant the second that disappointing outlook for the future was revealed.
Okay, so let's put all the pieces together. What's our take on HP going forward? It's time for the next call. All right, here's our call. First, our prediction. We think the stock's probably going to be stuck in neutral, just trading sideways, until we get some clear signs that those memory cost pressures are easing up, probably in the second half of next year. The key metric you've got to watch is free cash flow. That's the actual cash the company generates, and management guided for it to be pretty much flat. Honestly, if they can hit that target, it would be a huge boost to their credibility. So that leads to our rating, market perform. Look, the stock's valuation is cheap and it generates a lot of cash, which is great, but those near-term headwinds are just too significant to ignore right now, and they're going to cap the stock's potential for a while.
And as always, a final, important reminder. This explainer is for informational purposes only and should not be considered financial advice.